Imagine this. You buy a stock for $100. A few weeks later, it drops to $70. Logically, you should ask one simple question. Is this still a good investment? But instead, your brain says, don't sell yet. Wait till it comes back. Then it falls to $50, then $30, and somehow, you're still holding it. Not because the company is strong, not because the data supports it, but because your brain hates losing. And this tiny psychological quirk has destroyed more portfolios than bad companies ever have. Your brain was not built for financial markets. The uncomfortable truth is this. Your brain was designed for survival, not investing. Thousands of years ago, humans lived in environments where quick emotional decisions saved lives. If you heard something move in the bushes, you ran, even if it turned out to be nothing, because evolution favored people who reacted quickly. But modern financial markets punish those same instincts. Instead of helping you survive, your brain's shortcuts, called cognitive biases, often sabotage your decisions. Bias number 1, loss aversion. One of the strongest biases in psychology is loss aversion. Research shows losing money hurts about twice as much as gaining the same amount feels good. So when investors face a loss, their brain tries to avoid the emotional pain. And the easiest way to do that? Refuse to sell. This is why people hold bad investments far too long. During the 2008 financial crisis, many investors watched their portfolios fall by 30%, 40%, even 50%. Instead of reevaluating their positions, many held on, hoping things would recover. Some markets eventually did, but many individual companies never came back. The losses became permanent, all because the brain was trying to avoid admitting it was wrong. Bias number 2, herd mentality. Another powerful instinct is herd behavior. For most of human history, following the group was a survival advantage. If everyone in your tribe started running, you ran too, because they probably saw danger before you did. But in financial markets, this instinct creates bubbles. A famous example is the dot-com bubble in 2000. Internet companies with no profits, sometimes not even a working product, were worth billions. Why? Because everyone was buying them. Students invested, office workers invested. Even people who had never touched the stock market suddenly jumped in. People weren't analyzing businesses anymore. They were simply following the crowd, and when the bubble burst, the market lost trillions of dollars. Bias number 3, confirmation bias. Then there's confirmation bias. Once we believe something, our brain starts filtering information to prove we're right. Imagine you buy a stock because you believe it's the future. Suddenly, every article saying it's amazing feels convincing. Every video predicting growth feels reassuring. But warnings, risks, negative data, your brain quietly ignores them. Psychologically, it's easier to protect your belief than to challenge it. And this creates a dangerous echo chamber. You stop analyzing reality and start defending your decision. A modern example. We saw all of these biases play out during the crypto boom of 2021. Prices were rising rapidly. Social media was full of people posting massive profits. New investors rushed in because they feared missing out. This is called FOMO, fear of missing out. When prices started crashing in 2022, many investors refused to sell. They believed the market had to bounce back. But markets don't care about belief. They respond to reality, and billions of dollars disappeared. The real battle in investing. Here's the surprising truth. Investing is less about intelligence and more about emotional control. Your biggest opponent isn't the market, it's your own psychology. Because markets are unpredictable. But human behavior is extremely predictable. People panic during crashes. People chase hype during booms. People hold losers and sell winners too early, over and over again. How smart investors protect themselves. The best investors know their brain can betray them. So instead of relying on emotions, they build systems. For example, they decide in advance when to sell a losing investment. They diversify instead of betting everything on one idea. They step away from the news during market panic. And most importantly, they focus on long-term thinking instead of short-term emotions. because calm, rational decisions compound over time. Your brain wants certainty. Markets offer uncertainty. Your brain wants safety. Markets require risk. The investors who succeed aren't the ones with the most information. They're the ones who understand their psychology and refuse to let fear, ego, or impulse control their decisions. Because sometimes the most dangerous thing in investing is not the market crash. It's the brain making the decision right before it.